So you're ready to tap into your home's equity. Before you do, you need to know there's a brutal truth the banks aren't exactly shouting from the rooftops. Making the wrong choice here isn't just a simple financial oopsie, it's a mistake that could put your home on the line. As a former mortgage broker, I'm about to pull back the curtain and show you the hidden risks and real benefits that separate the homeowners who use their equity wisely from those who get trapped. Stick with me, and by the end of this, you'll know exactly which option is right for you, your home, and your wallet. Believe it or not, you're likely sitting on a mountain of wealth. As of mid 2025, American homeowners are holding a staggering amount of home equity. Some estimates put the total value of owner occupied real estate at over $49 trillion. dollars. For the average homeowner, this translates to hundreds of thousands of dollars in equity just waiting to be used. For so many people, this isn't just a number on a statement, it's a lifeline. It's the money for that new roof you desperately need, the funds to finally crush that high interest credit card debt, or the capital to launch the business you've been dreaming of. And the banks? Oh, they know. They see that mountain of wealth and they've created two primary tools to help you access it: the home equity line of credit, HELOC, and the home equity loan. On the surface, they look pretty similar. Both let you borrow against your house. But this is where it gets dangerous. They are fundamentally different, built for different needs, and come with vastly different risks. Picking the wrong one based on a slick ad or a misunderstanding of the fine print can be one of the most damaging financial mistakes a homeowner can make. My name is your name, and I spent more than a decade as a mortgage broker. I've sat at kitchen tables with hundreds of families just like yours. I've seen the hope in their eyes when they realized they could fund a child's education or build their dream kitchen. But I've also seen the fear and devastation when a client came back to me years later, their finances in shambles because they treated their HELOC like a credit card or were suffocating under a home equity loan they never fully understood. I'm not a loan officer anymore. I don't work for a bank. My only goal today is to give you the straight, unvarnished truth that I couldn't always share when I was part of the system. We're going to go way past the glossy brochures and fast talking sales pitches. We're going to break these products down so you can see how they really work, the psychological traps they set, and the life altering risks they carry. This isn't about good versus bad. It's about which loan is right for your specific situation and which one could lead you down a path to financial ruin and even foreclosure. Let's get into it. Before we pit these two against each other, let's get crystal clear on what they actually are, not what the bank's marketing team wants you to think. The confusion and the mistakes that follow start when people don't grasp the basic structure of each loan. Both use your home as collateral, meaning if you stop paying, the bank can take your house. That's the one terrifying thing they have in common. But that's pretty much where the similarities end. Part A, the home equity loan, the predictable powerhouse. First up is the home equity loan. I want you to forget about your house for a second and think about buying a car. You knew the exact price. You went to the bank, got a loan for that specific amount, and walked out with a check. From that moment on, you had a fixed interest rate and a fixed monthly payment for a set number of years. You knew exactly what your payment would be every single month and when you'd be done paying it off. That, in a nutshell, is a home equity loan. It's a lump sum fixed rate installment loan. Let's unpack that. Lump sum. When you close, you get all the money at once. If you're approved for $75,000, you get a check for $75,000. It's a one and done deal. This makes it perfect for large, known one time expenses. Need $28,000 for a new roof? A home equity loan gives you that up front. Need $50,000 to wipe out all your high interest credit cards? A home equity loan is designed for exactly that. Fixed rate. This is its biggest selling point. The interest rate you lock in on day one is the rate you have for the entire life of the loan, whether that's 5, 10, or even 20 years. As of late November 2025, average rates are hovering around 8.01%. So if your rate is 8.01%, it will be 8.01% on your first payment and your very last, no matter what the economy is doing. This gives you incredible predictability and peace of mind. Your payment will not change, protecting you from the risk of rising interest rates. Installment loan. You pay it back in equal monthly payments that include both principal, the money you borrowed, and interest. Just like your car loan or your main mortgage, every payment chips away at the balance. You're always making progress. The loan has a clear end date when you will be debt-free. So the car loan analogy really works. A home equity loan is like a car loan for your house. It's structured, predictable, and powerful for a single defined purpose. The bank hands you a pile of cash, and you agree to pay it back in identical chunks over a long time. Simple, predictable, rigid, and that rigidity is both its greatest strength and its biggest weakness. Part B, the HELOC, the flexible financial tool and trap. Now for the home equity line of credit, or HELOC. If a home equity loan is a car loan, a HELOC is a super-powered high-stakes credit card. I use the term high stakes for a simple, terrifying reason. Your house is on the line. A HELOC is a revolving line of credit with a variable interest rate. Let's break down what that really means. Revolving line of credit. Unlike the home equity loan's lump sum, a HELOC gives you a credit limit. A bank might approve you for a $100,000 line of credit. You don't get that money up front. Instead, you get what's basically a giant checkbook or a special card tied to this account. You borrow money as you need it up to your limit. If you need $5,000 for a plumbing disaster, you draw $5,000. A few months later, if you need another $15,000 for tuition, you draw that. You can borrow, pay it back, and borrow again, over and over. This is why it's called revolving, and this flexibility is its main appeal. Variable interest rate. This is the most critical and dangerous feature. The rate isn't fixed. It's tied to a benchmark, usually the US prime rate. Your rate will be the prime rate plus a margin, e.g., prime plus 1%. With the prime rate around 7.00% in late 2025, a typical HELOC might have a rate of 8% or more. If the Federal Reserve raises rates, your HELOC rate goes up almost instantly, and so does your payment. A HELOC is split into two phases, and this is where so many people get into trouble. The draw period, this is the first phase, typically lasting anywhere from 5 to 10 years, though some can be longer. During this time, you can borrow from the line of credit. But here's the magic and the trap. Your required monthly payments are often interest only. So on a $50,000 balance at 8%, your minimum payment might be just $333. It feels so affordable, but you're not paying back a single dime of the $50,000 you borrowed. You're just treading water. The repayment period. This is when the party stops. When the draw period ends, you can't borrow any more money. The bank then calculates a new, much higher payment that forces you to pay off the principal and the interest over the remaining term, often 10 to 20 years. This moment is so jarring it has a name: payment shock. Your monthly payment can easily double or triple overnight, even if interest rates haven't budged. So the credit card analogy is spot on. A HELOC offers amazing flexibility, but it comes with a variable rate that can bite you and a payment structure that can trick you into a false sense of security before the bill comes due. Okay, we've defined the two. Now let's put them in the ring side by side and break down their core differences. Understanding these distinctions is the key to making the right call. 1. How you get the money. Lump sum versus revolving credit home equity loan. You get one check, one time, you apply for $50,000 and $50,000 lands in your bank account. The reality, this is great for a single big expense where you know the cost, like paying off credit cards or a contractor's final bill, but it's inflexible. What if your remodel uncovers an issue and you need another $10,000? You're stuck. You'd have to apply for a whole new loan. On the flip side, what if the project costs only $40,000? You're still paying interest on the full $50,000 you borrowed from day one. HELOC, this is like a financial toolkit you can use again and again. You get approved for a credit limit, say $100,000, and you draw what you need when you need it. The reality, this flexibility is perfect for ongoing or unknown costs, like a home renovation in phases, college tuition, or just having a safety net. You only pay interest on what you've actually used. The danger? That easy access can feel like free money, tempting you to overspend. 2. The interest rate fixed certainty versus variable risk home equity loan. The rate is fixed for the life of the loan. If you sign at 8.25%, you'll pay 8.25% for the next 10 or 20 years. The reality, this offers total predictability. Your payment will never change, which is a huge relief if you're risk averse or think rates will rise. The downside, if rates plummet, you're stuck with your higher rate unless you pay to refinance. HELOC. The rate is almost always variable, tied to the prime rate. When the prime rate changes, so does your interest rate. The reality. This introduces uncertainty. If the Fed hikes rates to fight inflation, your monthly payments will go up. On a big balance, even a small rate increase adds up. Of course, if rates fall, your payment goes down, which is a nice bonus. The variable rate is simply the price you pay for flexibility. Some lenders offer a feature to lock in a fixed rate on a portion of your balance, but that comes with its own rules. 3. The payment structure, the slow grind versus the ticking clock. Home equity loan. Your payments are fully amortized from month one. Every payment includes both principal and interest, so you're always paying down your debt. The reality, you're building equity with every check you write. There's a clear finish line. It's a disciplined, straightforward way to handle debt. HELOC. During the draw period, often 10 years, you're typically only required to pay the interest. The reality, this is the most dangerous feature of a HELOC. The initial payments feel tiny. A $495 per month payment on a $70,000 balance at 8.5% feels manageable. But after making that payment, you still owe the full $70,000. You've made zero progress. The real pain comes when the draw period ends and your payment suddenly jumps to $650, $750, or even more as you're forced to pay principal. This payment shock has wrecked countless household budgets. 4. The use case, the surgical strike versus the long campaign home equity loan, best for a single, large planned expense. The reality, since you get all the cash at once and pay interest on it immediately, it's ideal for things like debt consolidation or a one and done home repair. Home equity line of credit, best for ongoing, unpredictable, or phased expenses. The reality, because you can draw money as you need it, it's perfect for a major home renovation, ongoing tuition, or as an emergency fund. Most lenders will let you borrow up to a combined loan to value, CLTV, of 80% or 85%, meaning the total of your first mortgage and the new credit line can't exceed that percentage of your home's value. One is about stability, the other is about flexibility. Neither is better, but one is almost certainly better for you. This is the conversation that you won't find in the bank's glossy marketing materials. As a former broker, I can tell you that while loan officers have to disclose the terms, they are paid to close deals. They aren't there to be your financial therapist or to question your spending habits. They're trained to highlight the good stuff, the flexibility, the low payments, the big check. It's on you to understand the real risks. And the biggest risk is this: you are securing this debt with the roof over your head. A default isn't just a ding on your credit, it's a foreclosure notice. Let's break down the hidden dangers of each. The brutal truth of the HELOC. Your home as a casino chip. The HELOC is, without a doubt, the more dangerous of the two for the average person. Its flexibility is a double-edged sword. The magic piggy bank. Trap. This is the number one danger. Because the money is so easy to get, just write a check or use a card, people start treating their home equity like a checking account. The line between smart investment and reckless spending gets blurry, fast. The bank doesn't care if you use it for a kitchen remodel that adds value or for a luxury vacation and designer clothes, but you should. I've seen people fund a lifestyle they couldn't actually afford with their home equity line of credit, paying for dinners and gadgets. They were literally spending their house, one purchase at a time. The interest-only payments made it feel painless until it was too late. The variable rate. Nightmare. We live in an uncertain world. The idea that interest rates will stay low forever is pure fantasy. HELOC rates are tied directly to the prime rate, which is heavily influenced by the Federal Reserve. A sudden spike in inflation or a change in economic policy can make rates soar. If you have a $150,000 balance, a 2% rate hike means an extra $3,000 a year or $250 a month in interest. Can your budget handle that? What about a 3% or 4% increase? The bank advertises today's rate, but you're taking on interest rate risk for the next 2 or 3 decades. The payment shock time bomb. This is baked into the very structure of most HELOCs. For 10 years, you make small, interest-only payments, you get used to them. Then the draw period ends, your line of credit is frozen, and the loan converts to a fully amortizing payment. Your payment skyrockets. I saw a client whose interest-only payment was around $600 on a $90,000 balance. When their repayment period started, their new payment jumped to over $1,100. That's an extra $500 a month they hadn't planned for. It's a leading cause of HELOC defaults. The bank discloses this in the fine print, but few people truly grasp the reality until that first new bill arrives a decade later. The frozen credit line. Here's something almost nobody talks about. Your HELOC agreement almost certainly has a clause that lets the lender freeze or reduce your credit limit. Why? A big drop in home values is a common reason. If the market crashes and your home's value plummets, the bank might get nervous and cut your available credit to protect themselves. This can be a disaster if you were counting on that money for a project or as your emergency fund. The cash you thought you had can vanish overnight. The brutal truth of the home equity loan. The concrete straitjacket. The home equity loan is safer, but it's not without its own harsh realities. Its biggest danger comes from its rigidity. The inflexibility trap. You get one check, that's it. But life is messy. Let's say you borrow $40,000 for that kitchen remodel. The walls come down and you find a massive termite problem that's going to cost $15,000 to fix. Your project just became a $55,000 project, but you only have $40,000. You can't just get more. You're stuck. You'll have to scramble for another loan or put it on credit cards. The loan's predictability just became a rigid cage, paying for money you don't need. This is the other side of the coin. What if that $40,000 project comes in under budget at $35,000? Now you have $5,000 cash sitting in your account. Sounds great, right? Wrong. You're paying interest on the entire $40,000 from day one. That $5,000 isn't free money. It's a loan you're paying for but not using. The temptation to spend it on something fun is huge, and you'll be paying for that impulse for the next 15 years. The psychological weight of debt. When you take out a $75,000 home equity loan, your debt load jumps by $75,000 in an instant. You now have another big fixed monthly payment on top of your mortgage and everything else. It adds a ton of financial and psychological pressure. If you lose your job, that payment is still due. It's a relentless obligation that doesn't care about your circumstances. The ultimate brutal truth: foreclosure. Let's be perfectly clear. Both of these are loans secured by your home. If you can't make the payments because your HELOC rate went through the roof, you got hit with payment shock, or you lost your job and can't afford the home equity loan payment, the bank has the legal right to foreclose and take your home. People get into trouble when they think of this as tapping equity or unlocking value. That's just marketing speak. The brutal truth is that you're taking out a second mortgage. You're adding another layer of debt to the most important asset you own. It is not free money. It's a loan with the ultimate risk. Okay, enough with the scary stuff. Despite the risks, these can be fantastic financial tools when used correctly. The key is matching the right tool to the right job. Let's walk through a few case studies based on real situations I've seen to show when each product really shines. Case study number 1, the renovators' Sarah and Tom's phase project, perfect for a HELOC. The situation: Sarah and Tom have about $150,000 in equity. Their home is functional but dated, and they have a 3-phase plan they want to tackle over the next few years. Remodel the bathroom, $20,000. Finish the basement, $35,000. And build a new deck, $25,000. The challenge: the total cost is about $80,000, but the expenses are spread out and the final costs are uncertain. They don't want to pay interest on $80,000 from day one. The smart solution: a HELOC. They get approved for a $100,000 HELOC, giving them a nice buffer. Phase 1, they draw $20,000 for the bathroom. They only pay interest on that $20,000. Phase 2, 9 months later, they draw another $35,000 for the basement. Their balance is now $55,000. When the contractor finds an unexpected issue that costs an extra $3,000, it's no problem. They just draw the extra cash from their available line. The HELOC's flexibility saved the day. Phase 3, a year later, they draw the final $25,000 for the deck. Why it worked: the HELOC was perfect for their spread out and unpredictable expenses. They only paid interest on what they were actively using, saving them a ton of money compared to taking a big loan at the start. Case study number 2, the debt consolidator. David's escape from credit card hell, perfect for a home equity loan. The situation: David has racked up $28,000 in high interest debt across 4 different credit cards, with interest rates ranging from 21% to nearly 30%. He's paying a fortune in interest and feels like he's getting nowhere. The challenge: David needs a structured, disciplined way to get out from under this crushing debt. The smart solution: a home equity loan. He gets a $30,000 home equity loan with a 10-year term at a fixed rate of 8.5%. The action: he receives the $30,000 lump sum and immediately pays off all 4 credit cards. He puts the remaining $2,000 in savings. The result: he's traded chaotic 25+% average interest for a single predictable payment at 8.5%. His new payment is about $372 a month, and every single payment includes principal. In 10 years, he'll be debt-free. Why it worked: David's problem was a single known number, $28,000. He didn't need flexibility, he needed a surgical strike. The home equity loan gave him a clear path to recovery. A HELOC would have been dangerous here. The temptation to run up the credit cards again is a common trap. Case study number 3, the entrepreneur. Maria's business safety net, a strategic HELOC use. The situation: Maria is starting her own business. She has savings, but she's worried about uneven cash flow in the first year. The challenge: she doesn't need to borrow money now, but she wants a safety net in case a client pays late. The smart solution: a HELOC. Maria gets a $75,000 HELOC and doesn't touch it. The result: the HELOC acts as her emergency business line of credit. For 6 months, it costs her nothing, besides maybe a small annual fee. In month 7, a client is late on a payment and she needs to make payroll. She draws $10,000. 2 months later, the client pays and she immediately repays the $10,000 plus a little bit of interest. Her full credit line is available again. Why it worked. The HELOC gave Maria priceless peace of mind and stability at a very low cost. A home equity loan would have been a terrible choice, forcing her to take on debt and a monthly payment she didn't even need yet. These stories show this isn't about a winner or a loser. It's about an honest assessment of your problem and picking the tool designed to solve it. Section 5, the verdict: which is right for you. So, after all that, how do you choose? It comes down to a moment of radical honesty. You have to look in the mirror and understand not just your financial goals, but your financial personality. You should choose a home equity loan if you're a one-time project planner. You have a single big expense with a known cost, like a firm contractor quote or a specific pile of debt to pay off. You need a lump sum. You're also a certainty seeker. The thought of a variable rate makes you sick. You need to know exactly what your payment will be every month. You value stability above all else. Finally, you know you need structure. The idea of an interest-only option is a temptation you'd rather avoid, and the loan's rigidity is a feature that protects you from yourself. If that sounds like you, the home equity loan is your safer, smarter choice. You should choose a HELOC if you're a phase project manager. Your costs are spread out over time, like a multi-stage renovation or years of tuition. The ability to draw money as you need it is key. You're also a flexible strategist. You're okay with some managed risk. You understand how variable rates work and are willing to trade certainty for flexibility. Most importantly, you are exceptionally financially disciplined. You have the self-control to pay down the principal even when it's not required, and can handle a credit card-like product secured by your house without treating it like a personal slush fund. If you honestly fit this profile, a HELOC can be a powerful and cost-effective tool. When you should choose neither, there's a third option that loan officers won't pitch: walking away. You should avoid both loans if your income is unstable. Taking on new debt secured by your home when your job is shaky is like pouring gasoline on a fire. You don't have a clear plan for the money. If you just think it would be nice to have extra cash, stop. That's how financial disasters start. You're trying to fund a lifestyle. Using your house to pay for vacations or fancy cars is the fastest way to destroy your net worth. You have no other savings. If your home equity is your only major asset, don't leverage it for anything but a true emergency. We've covered a ton of ground. The final piece of advice I can give you after years of seeing both success stories and tragedies is this: slow down. Lenders are built to create urgency. They'll push limited time offers to get you to sign quickly. Resist. The decision to put a second mortgage on your home should be made calmly and deliberately. Before you sign anything, do these 3 things. First, shop around. Don't just go to your own bank. Get quotes from at least 3 to 5 different lenders, including local credit unions. Compare not just the rates, but all the fees: origination fees, annual fees, and any prepayment penalties. Second, interrogate the loan officer. Don't let them just give you the sales pitch. Ask the hard questions. For a HELOC, make them show you what your payment would be if the prime rate went up by 3%. Ask for a real calculation of your principal and interest payment after the draw period ends. Make them earn their commission. And third, create a worst case scenario budget. Sit down and write out your monthly budget. Then create a second version where your HELOC payment has doubled or your income has been cut by 20%. Can you still survive? If the answer is no, you're taking on too much risk. This decision is about so much more than rates and terms. It's about protecting your family's future and the most important asset you'll ever own. I really hope this breakdown has armed you with the confidence to make the right choice. This is the kind of insider info I wish every homeowner had. If you found this helpful and you want more of the brutal truth about real estate and mortgages, do me a favor and like this video and subscribe to the channel. It helps other homeowners find this content. And now, I want to hear from you. The best conversations happen in the comments. Leave a comment below with your biggest question about home equity. I'll be in there answering as many as I can. Do you have a story to share? Let's all learn from each other. Thanks for your time. I'll see you in the next video.